municipal bonds, why are they special? Why are they not taxable? Why is the interest on them not taxable? Any guesses? So these are bonds. So in the case of a municipal bond, the taxpayer purchases, let's say purchased $10,000 municipal bond from the city of Ames because the city of Ames is wanting to build a swimming pool, and so they use that $10,000 to help build the swimming pool, but they pay me interest as a taxpayer on that $10,000, but I don't have to pay tax on that. I have to report it, but I don't have to pay tax on it. Why is that special? Any thoughts?
Because it's for like everyone or for like betterment of the area or something.
Right. It encourages people to invest in their local communities. Now, the trade-off on that is that usually the interest rate is lower. So maybe I have $10,000 and I'm going to decide, am I going to buy a corporate bond, which pays me 6%, or I'm going to buy a city bond that pays me 5%. Well, I'm going to get less income from that city bond, right? If it's $10,000, then every year I'm going to get $500. Is that right? Whereas with the corporate bond, I'm going to get $600. However, if we look overall, I'm going to pay less in tax. So ultimately, I'm going to net a greater amount. So when investors are looking at those options, they would want to weigh the two. What's their tax rate? So if they happen to be a taxpayer, if helping their community is completely not part of the equation, they're just looking at financially what's best off for them, but they don't actually pay any tax, then it might be better to get the corporate bond, right? However, if they're looking to cut their tax bill, then the municipal bonds are a good way to go. Okay, so that's the reason that that they're given beneficial treatment. But like I said, there's a trade-off for it. All right, dividends. So you guys have all had financial accounting, and a lot of you are in intermediate accounting now. You know what dividends are. So dividends are distributions of property by a corporation to its shareholders. So these are amounts that it's kind of out of the retained earnings of the corporation. They are sharing the wealth with their shareholders. Dividends are not deductible for corporations. They don't get any tax benefit from paying dividends to their to their shareholders. What they get is goodwill from and hopefully a reputation that they will pay dividends, and so more people will invest in their company. But they don't get any type of write-off for paying those dividends. And the dividends are taxable to the taxpayer. This is one of those rare areas in the tax code where there is not a benefit to offset a detriment. Usually in the tax code, you're always going to have two sides to the equation. If I have income, that means somebody has paid me money, they're getting a deduction. My income is somebody else's deduction. My deduction is somebody else's income. It's offset, it equals out. So it's kind of all balanced, right? Dividends are a different story. And this is where the double taxation comes in. If you've ever heard of that term, double taxation, dividends there is income, but there's no offsetting deduction on the other side. The corporations don't get a deduction for that. So, but dividends do have certain preferential treatment for individuals who are receiving them in the form of a reduced tax rate. But I will tell you, when you do your problems, this is going to give you some headaches trying to figure out, because now we're adding a little wrinkle to that tax liability calculation. Because now we've got a different type of income that's going to be taxed at a different rate that we're going to have to pull out and separate, figure out what the liability is on that, figure out what the liability is on the rest, and then add that liability together. okay? So, usually dividends are paid in cash, but there are some instances where they can be paid in property as well, or in stock, in the form of stock. So a stock dividend is just a distribution of more stock. So I own 10 shares of stock. The company is paying a dividend of 1 share for every 10 shares you own. Now I own 11 shares of stock. Right, so instead of getting cash for it, I got an additional share of stock. Doesn't cost the company anything, really, right? Doesn't cost them any cash to issue that additional share of stock. So stock dividends and stock splits are generally not taxable to the shareholder. Because essentially what you're doing is adding to the asset that the shareholder has. So that transaction hasn't really completed at that point. Until the taxpayer actually sells that stock, it's not a completed transaction. And so actually just receiving the stock isn't taxable. But what it does is it changes the overall, what we call basis. Trying to remember the financial accounting term for it. The cost, the book cost of that stock overall. So if my stock was worth, let's say, I own 10 shares, and I paid $100 for my 10 shares. And then I get a stock dividend of 1 additional share. This is what we call our basis. Okay? I'm getting a little ahead of myself here, but this is like the book value. This is our basis. This is our cost for what we paid. I've got now 1 additional share. So each of these, originally each of my shares was worth $10. That was my basis of this share was $10. Well, now I have a total of 11 shares, but my basis is still overall $100. So now my basis per share has diminished. So when I go to sell it, that's going to affect what I actually have to record as income. Okay? Like I said, getting a little ahead of myself there with talking about basis, but it kind of feeds into this whole stock dividend conversation. Certain stock dividends, though, are taxable, but they're limited to what they are. So stock dividends in which the shareholder has the option to receive stock or cash or their property. So if I had the choice and I receive stock, then it is a taxable transaction, but then then I get basis on it so that it reduces my future gains. Disproportionate dividends, if some shareholders receive property, other shareholders receive an increase in their stock interest, so it's different depending upon the type of shareholder, then it would be taxable. Distributions of preferred stock as well would be taxable. All right. So, but usually what we see is dividends are paid in cash. Okay? So when they're received, they are going to be taxable. Is everybody familiar with what mutual funds are? Sort of? Okay. Mutual funds are a very common type of investment. What mutual funds do is they combine shares from multiple companies. So if you have a mutual fund, you own a little bit of a bunch of companies. So instead of buying 1 share of Apple, you instead buy 1 share of a mutual fund that owns a little bit of Apple, a little bit of Microsoft, a little bit of Tesla, a little bit of, I don't know, some other tech company. And so it's all pooled together. So what it does is it distributes your risk. It lowers your overall risk. So now you're not dependent on just Apple going up. Now you can depend as well on, oh, well, Microsoft will go up, or, you know, it spreads out that risk. It also minimizes your upside potential on it, but it minimizes your downside potential as well. So mutual funds, they pool financial resources of thousands of individuals to purchase stocks or bonds. So you're not the only one that's buying this. You've got a lot of other people that are buying this as well. They're required to distribute the income that they receive, either in the form of dividends from holding stocks or capital gains and losses from the sales. So these dividends, you may receive dividends from these mutual funds, or you may receive dividends that are then reinvested to buy more shares of the mutual fund. Either way, it's dividend income. You don't see it yourself. You don't see the individual dividends coming in, but it's part of the mutual fund income, okay? So that's another way that individuals can receive dividends, either directly from companies that they're invested in or indirectly through mutual funds that they're invested in. And those are very common ways of receiving dividends, okay? All right, hold on just a second. So far, we have talked about one tax rate for all types of income. However, certain types of income are taxed at different rates. I wish they would give us a table. You're going to be searching. In the back of your book is a table of the capital gains, their capital gains and dividend tax rates. It's one of the appendixes. I can't remember off the top of my head which one it is. It will be in the form of a table. Your chapter doesn't do that. They put it, it's nicely placed in a paragraph, which makes no sense. But these are the tax rates for dividends, right here. So for individuals, and it depends on filing status, again. So for individuals that are married filing jointly, I'm just gonna put this, I'm gonna try to put this in a table format. Taxable income of less than $89,250. So married filing jointly, this is taxable. Head of household, again, taxable income of less than $59,750. Married filing separately or single, and this would include qualifying widow or widower as well, of less than $44,625. Tax rate on dividends, only the dividends. All other income has a different tax rate. Tax rate on the dividends is 0. So you do not pay tax on your dividends. These are the same tax rates as for capital gains, which we'll get to, but again, a lot of students forget about this when they're doing their calculations, especially on the tax return problem for this chapter. So you have to remember this, and we'll go through some problems on how to calculate this. So income up to 5, look at this bracket. So less than 89. So what am I doing? 89,250. Greater than 89,250 up to, I never know how to do these right, by the way. 553, 850. That's a big range, isn't it? Holy cow. It's about 500,000. Married filing jointly, 276,900, so between 59 and 750, 276,900. And then this one is, wait a minute. No, they did, see, this is dumb. 44,625 greater than, but less than, okay, 276,900. See, they didn't even put it in the same order. 523,050. Oh, because it's different, okay. 523,050. Okay, so the 276 is married filing separately. Single is 492,300. So this is just married filing separately. I'm sorry, no, this is kind of a mess. I was trying to make it easier to understand and I didn't really do that. 44,25 up to 492,300. Tax rate is 15% on the dividends, only on the dividends. And then for greater than these amounts, so I'm just gonna put a plus. Anything above that, 20% is the dividend tax rate. This is for, these are for what are called qualified dividends. Okay. So if it's not a qualified dividend, it doesn't get the benefit of those tax rates. What are qualified dividends? These are dividends that are paid from the earnings and profits of the taxpayer, of the payer corporation, meaning they didn't take out a loan to pay dividends. They have retained earnings. And they are from domestic corporations or qualified foreign corporations, which would be determined by the IRS, whether they fit that. If it's a qualified dividend, it's gonna say so on the 1099. You don't have to determine whether it's a qualified dividend or not. Right. So, let's take a look here. Single individual who has taxable income of $110,000 before dividends. So, these are the amounts, these are before dividends. Okay. So if you've entered the dividends in and they're included in that taxable income amount, you gotta take them out. You'll have to subtract them or just don't enter them yet, right? So you determine how much the taxable income is before dividends. If it's a single individual, their income, ordinary income, we call this ordinary income, by the way. All of the income that is taxed at those bracketed rates that we talked about, that's called ordinary income. That's gonna be at the 24% marginal tax bracket. Then if the individual, that individual receives a qualified dividend of $1,000, the tax rate applied to that dividend would be 15%. Most people, it's gonna be 15%. Most folks. Not all, but most. This is how it's determined. So you're gonna take the taxable income before the dividend, subtract out that dividend amount, and then calculate the tax liability. You calculate the tax liability the same way we have done. Okay, either use the tax tables or the schedules. In this case, we'd have to use the schedules because it's $110,000. So you calculate that, and that's what all of this is up to here. You just So you've separated the dividend from that. And you're doing the calculation just like what we've already done. Then you're gonna take the dividend amount and you're gonna calculate the tax on that. Then you're gonna add those two amounts together. It's really not that hard, but it's easy to forget to do it. Okay? So, let me see. Here is a 1099 DIV, and you can see there's two boxes here. Box 1A says total ordinary dividends, box 2B says qualified dividends. This is actually total dividends. So if some of these dividends aren't qualified, well, let's say, let me back up. If all of the dividends are qualified, these two boxes are going to say the same thing. These qualified dividends are telling you how much of these ordinary dividends are qualified. So this number is included in that number. So there's always going to be, it's not over and above. It's not, oh, we had 200 ordinary dividends plus we had 200 qualified dividends. No, it's, we had 200 dividends. Of those 200 dividends, all 200 were qualified. Okay, does that make sense? So it's not, these two boxes are not added together to total all of the dividends. Your total dividends are right there. But it's just classifying how much of those are qualified. Okay? That's different from the interest income. That interest income, remember we've got the tax exempt box and we've got the interest income box. Those are completely separate amounts. So your total interest would be added together on those. But that's not the case with dividends. Okay? Really, the only thing that you need to be worried about on this form are those two boxes. There is a box for federal income tax withheld. There's hardly ever federal income tax withheld. Sometimes there is. I don't think there's any on your problems. But just in case, box 4 there. And that would go then on page 2 of the 1040, where it says 1099 withholding, and then there's a line for 1099s, withholding from 1099s. Let's see. So you always do the dividend income last, because you're gonna do that separate tax calculation, okay? Let's do, let me show you an example. Let me make something up here. So, let's say we've got married filing joint and they've got wages, combined wages of 90,000, and then they've got taxable interest income of 1,000, and then they've got qualified dividends of 2,000. First thing we're gonna do, well, first off, we gotta get down to our taxable income, right? To figure out our tax. So our taxable income is gonna be this, minus our standard deduction, right? Of 27,700. So 300, what is this? 8, 9, 1, 9, 2, 62,300. Here's our taxable income. We would determine what, using our regular tax rates, what that tax is. So if somebody wants to look that up, they're welcome to do so. So married filing jointly, taxable income, of 62,300. $7,039. Okay. Now, we gotta determine how much the tax is on our qualified dividends. This is, let's see, their taxable income. I did the wrong, well, no, that's all right. So their taxable income is 62,300, and remember, I gotta get back to our taxable income before our dividend, 110,000 at 62,300 and married filing jointly. I gotta go back to their lovely little paragraph here.
It's less than 89,250.
89,250. So our tax rate is 0%. So 7,039. So calculate the taxable income before the dividends. Calculate the tax on that separately. And then take the qualified dividends, calculate the tax on that based on that bracket, where they land. Let's see. You guys doing all right? Do you need, it's 10 after 2. Do you want to get up and stretch? Or you're, yeah, okay. Let's take just 5 minutes then. And then we'll continue with